From the morning reading, a perfect storm. Resistance breakout to the upside. The Qs plus 3%. Spiders, diamonds, IWM plus 2%. Rally broad and big. 8 of 9 sectors moved higher on Tuesday. XLF, XLK, and XLY were the strongest sectors, while XLU was the weakest sector. Oil futures flat at only a plus 0.02 to close at 33.89. Breadth strengthened as advancers led decliners 4.6 to 1 on the New York Stock Exchange and 2.99 to 1 on the NASDAQ. For 6 trading days, the SPY has been churning at resistance, breaking out twice but unable to pull away from resistance. On Tuesday, that changed. Buyers bought and bought big on Tuesday, driving the Spider, Diamonds, Qs, and IWM through resistance. Over 450 SPX stocks advanced, 97 of the NASDAQ 100 moved higher, and all but 1 of the Dow 30 rose higher. 29 of the Dow stocks rose on Tuesday, led by gains in JP Morgan, Apple, Goldman Sachs, Microsoft, Merck, Visa, Intel, IBM, and GE. The market rally pushes major indices up over the 50-day averages to strengthen short-term trend. Industrial and technology spiders clear 200-day lines. Emerging markets lead global rally. Taiwan semiconductor breaks out. Semiconductor ETFs test 200-day lines. Over the past 50 sessions, 28 of them saw the S&P move more than 1%. Such high volatility coming on the heels of an extended uptrend is often seen as a precursor to a period of volatility and lower prices. That was the case after this happened in 2000 and 2007, but overall it was an inconsistent predictor. On a daily basis, though, it would be better if volatility dampened and we saw fewer 1% days. Our risk level has been falling. This is something we've touched on almost every day for weeks, as a failure to see weakness in spite of short-term optimism is a good medium-term sign. When stocks rally hard to a 1-month high in a downtrend, we should pay attention to the short term. If buyers push stocks higher in the next several days, it has led to medium-term gains more of the time. If stocks pull back, it has been the opposite. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:52 a.m. Central Time, and I'm recording this in preparation for the market day of March the 2nd, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Remember that when you're on YouTube, you can get a free subscription to the channel and be alerted when new content is published. Give the video a few minutes after being published for the video to be available in high definition, which is particularly good to see the charts. Click on the setting button to choose high definition playback level. In the same area, you can also control the speed of the playback. I routinely find that I can understand videos at about 1.5 times the recorded speed. So let's go ahead and dive into the morning report. And not terribly active last night. At the time of this cut, the S&P futures were down about 0.25%. The Russell's essentially at scratch, NASDAQ just below scratch, and the Dow down about 0.1%. Crude oil down about 1.8%. Euro down just below scratch, as are bonds, and then gold is just above scratch. China up big, about 4.27%. Hong Kong up about 3%, Japan up over 4%, Germany up just above scratch, and the United Kingdom down about 0.25%. In terms of macroeconomic reports for today in the U.S., we have crude oil inventories in its normal slot. We have ADP non-farm employment change, and that's about it of any note. In terms of looking forward, of course, Friday we had the monthly employment report, one of the big 4 reports, so keep that in mind. You have the weekly version of the unemployment on Thursday morning. Also, ISM non-manufacturing PMI. and nat gas and factory orders. So that should take care of us on Thursday. In terms of current volatility conditions, obviously a lot of stuff been calming down here of late. Short-term VIX down to a 17, and the skew also quite benign at a 119. So this is the first time we've seen the short-term VIX get down below, clearly below 18 in quite some time, probably a couple months at least. IV percentiles on the S&P at 22, the Russell 26, NASDAQ 22, Dow 24. You see we had 2 standard deviation moves put in on all 4 of the indices yesterday, so very, very big action there. In terms of the charts, we have here the S&P futures, and you see just how big that was yesterday. Not just as a percentage, not just as a standard deviation move, but look at what it did. It took out and clearly broke through the resistance area. We'd had as one of the morning authors from the morning reading mentioned, we'd had a couple attempts to break out, but they had failed last week. Well, this one was far more decisive, and look at this, it clears the cloud as well. So we have a very, very decisive breakout with yesterday's action. This is also reflected on the Dow. And remember, we also had some kind of false breakouts from resistance there. Well, this one also clears that whole area, also breaks above the cloud. Now, the other indices have more room to make up. And when we look at the NASDAQ, we see it brought this action to a clear new high in terms of this most recent activity, both a couple days ago in terms of trading days, and then also this swing high. But we also had other resistance, and this was, remember, we talked about an area, and it still has yet to clear that, and it is still yet to clear the cloud. So to be in relative purposes to where the Dow and the S&P is, we need the NASDAQ up here. So a little bit more work left to do, but still, that's a pretty big move yesterday, pretty decisive, and certainly is setting up for better things. In terms of the Russell, another one that has to make up a lot of damage, well, we also have cleared this nearby resistance areas, but also a smack in the middle of the cloud. So there's going to be a little bit more work for the Russell to do to be able to catch up in relative sense to where the Dow and the S&P are. But certainly, you know, this is big. And in fact, if you look at this, we've gone from 936 to, in the internight last night, as high as 1058. And without so much as any kind of pullback at all. You've got 3 small red candles in here, all inside days. On prior days, we've not had a close below a prior day in this entire move. So that's a very, very long way for the Russell to go without any kind of retracement. And pretty unusual to go more than 100 points, and very, very unusual to go more than about 150 or 160. And let's see, 936. So we've gone about 120 something points, 123 points or something like that, without a pullback. So we're starting to get into rare exhaustion type patterns, likely to show up soon on the Russell. So just kind of keep that in mind. That frankly, this probably can be said for some of the other patterns. So we've seen more significant retracements in some of the other indices. In terms of the VIX, you see that we have definitely been coming down, and the VIX futures still haven't cleared the 18 area. That's down here, and you see that there's, you know, pretty significant support in this area. When it's gotten to this area in the past, it has pretty much reversed. That's been kind of that tone, that more bearish market tone, where you keep the volatility in a relatively high area, especially not down here in this 12 to 18, and more importantly in that 12 to 15 area, which is where healthy bulls typically reside with their volatility. So very much respect the fact that this has come from the 30 area down towards the 19 area, and yet at the same time there is certainly additional volatility that's still being priced in to this market, and will have to take some time to ebb away. Bonds also coming down, and we've been talking about how this had kind of gone into a consolidation pattern. Well, that broke down yesterday, and we definitely saw, a risk off going on there. So risk off there. What about gold? Well, gold's holding on, so it continues to hold on to this consolidation pattern. Looks like a flag pattern or triangle pattern here, with the expectation that it should break up to continue the prior trend. So in that case, the risk off has not shown up in gold as you might expect. So a little bit of a more neutral kind of signal. And let's see, I think we've taken care of everything there. Let's go to the daily report. With the daily report, of course, we continue to see improvements here. Phase 4, price patterns near horizontal resistance. We've now broken out from the first significant horizontal resistance, and we'll start to play with a combination of bull flags and horizontal resistance. There are some more very, very important horizontal resistance just ahead in the S&P, and especially if you start looking at wedge patterns, and other more longer term patterns, there's a lot of significant resistance coming into play in the not too distant future, especially around 2000, 2010 on the S&P. So anyhow, phase 4, which is bullish, this can last multiple weeks. That's a good sign. Also a good sign, IBD has been in confirmed uptrend for a number of days now. The accumulation distribution scores have improved just a little bit. The S&P and the NASDAQ at a D. The GMI index also improved a notch to a 3 out of 6, though it is still sitting on a sell signal. Also, the stock charts decision point scoreboard is still sitting with a lot of very neutral to even bearish settings on the intermediate term, and all out bearish on the long term. So a lot of damage yet to be fixed here. Overall consensus, when you put all this together, is that we're still, a bit of a market in transition, in that we've got to get the stacks to line up, and that's going to take a while because of the damage that was done. But we clearly are improving the bias to the bullish side with every day. This move yesterday was significant, and you should treat it as such. Position sizing opinions are at 100% and 75%. Intermediate term market postures very strongly bullish, with a weak bullish sentiment line now supporting that, improving there. And you see the S&P at a 91, the Dow at a 90 also, so very, very high. Look at the Russell. Russell's now in the very strongly bullish area, and actually the NASDAQ is the weakest of the 4 indices, so kind of interesting to see that. We are in a weak bull trend at this point in the big picture, so don't get too far ahead of this, and yet be increasing your exposure little by little as this situation continues to improve. Hedge warning status has changed. I've changed it down to a 0+. 0 is normal. We've got a little bit of elevated risk factors still present, but we're certainly not a full-out healthy bull. I don't want to go to a 0 as of yet. We've got to get these time frames to stack up to be bullish, to be able to flat out 0. But clearly a lot of the risk has ebbed in the last 2+ weeks. In terms of option income strategies, we also had a change in our opinion here. We're now calling this borderline acceptable to initiate new positions for novice traders. Consider reduced position sizing. Of course, the more aggressive traders will find that these still elevated volatility levels offer greater premiums, and they're prepared to take the additional adjustments that come with larger than normal volatility and delta moves. In terms of cover call strategies and put selling, no change from yesterday on these two opinions. Conditions are acceptable to initiate new positions for novice traders. Still consider a range of defensive construction aspects that could well serve you well if we should roll back. If you follow what the institutions are doing, They have been very, very defensive in where they've been moving money, utilities, consumer staples, and REITs and gold and things like that, bonds, have been doing very, very well until just recently with this breakout. Now it's a bit more blended, and we are starting to see some money move into those higher beta areas. So you should be following that and mimicking the institutions with your own portfolio growth as you add on positions. In terms of specific warnings, we've got a couple, nothing terribly exciting here. Market and decline still is present. VIX futures, of course, the futures is still up over 18. The expected week out move on the SPX is a 44. This drops off of warning status when it drops below a 40, so not too bad there. You see the new highs, new lows yesterday, 684. This is back-to-back days with very, very impressive new highs on the New York Stock Exchange. Risk on and all of our risk aversion indicators. Short-term sentiment indicators, you notice that short-term stocks has now gotten to an 8. That's reflecting the fact that we're probably getting to be fairly overbought and are at some risk for a pullback. Also, and these are in order of just how high their sentiment ratings are. If you're in high yield, retail, housing, mining, industrial, semis, basic materials, consumer discretionary, REITs, and technology, their sentiment readings are starting to get pretty high. So you should also be watching for potential reversal patterns there as well. And if they should show up, you might consider start tightening up stops, especially on swing trades in those areas. Also, sentiment with the fear and greed index, you notice now 62, starting to get up into the greed area. So quite a contrast to where we were. We've been spending so much time down here in fear, starting to flip over to the greed side. So a sign there. In terms of decision point market posture of key indices that are bullish, we also had materials on the equal weight join the group yesterday, so be aware of that. And you see also industrials, consumer staples, gold, utilities, and the long bond, all with intermediate term bullish market postures. In terms of sector specific, a sea of green on the short to intermediate, now starting to fill into the long, no reds at all. So quite a bit of improvement coming in terms of the percent change. You see, look at how big these are. And these, yesterday, like I said, we're starting to see more interest in the higher beta areas. The financials, technology, discretionary, those are high beta. They have not been where money has been rotating up until not in a significant way up until yesterday. And with that breakout, not only was that a big move, it was a big move into the higher beta areas. And you see down here, look at what's at the bottom. Telecom, consumer staples, utilities. The defensive ones are at the bottom. Now, generally up, but still much of the money was moving into the more riskier exposure yesterday. So that's a change, and you should note that. Okay, I think that's enough for today. Let's go ahead and take a look at this. We talked recently about how to get the emails. You've got the directions right here. Just hit that hyperlink, go to that button, and put in your name and address, and that will get you signed up for a limited number of emails that we send out, alerts when there's a head risk level change, especially when it goes up, and then also periodic blog articles. Also, by joining the email list, you'll get a copy of the ebook Portfolio Strategy. You can also do this through the smartphone. Just text Falcon Global, all one word, to 22828. And let me see. Let me mention about this. Middle of the class right now in the Cover Call Mastery course. But we will be setting up for another round of this course in middle of July. If you've got an interest in developing a complete and comprehensive trading plan around the cover call strategy, just go to this hyperlink here. That'll give you additional details. If you'd like to express an interest, just send me an email to Steven@FalconGlobalTraders.com, and we'll put you on the interested list. And then when we get closer, we'll send you the registration and all the details. But this will be a live course in the Chicago western suburbs. and can also be simulcast. So if there's somebody who is away and from the Chicago area and wants to participate, we can certainly make that happen as well. But this is a very, very comprehensive course. If you've ever wanted to have a complete trading plan, this is definitely a way to go. Also, if you've never had options exposure before, the cover call is a great way to get an understanding and initial training around the use of options with a strategy here that's actually more conservative than owning the stock by itself. So that might be of interest for you there. I'll just roll through the rest of these. You can hit pause if you see something of interest. Disclaimers as always, hit the pause button if you need more time to review. Also at the bottom you see the full hyperlink to take you to the full set of disclosures. We'll see you back here tomorrow morning with the Falcon Global Market Preview. Good trading.